the needle on the record.
Welcome to Wage Cucking with JMO.
All right, guys, welcome to another episode of Wage Cucking with JMO. We were on a brief hiatus, but we're back today with a guest, Dion from Term Finance. Dion, how you doing?
Good. Thanks for having me. Excited to be here.
Before we get started, you want to give me a quick intro as to your background, how you got into crypto, and how Term Finance came to be?
Yeah, for sure. So my background is in traditional finance. Started my career in '06 at a hedge fund in New York called D. Shaw. Was here for a couple of years. Was interested in public policy, so moved down to DC to join the Federal Reserve Board of Governors. Was there from '07 to '09, so bracketing the financial crisis.
Mm-hmm.
And it was definitely an interesting time to be there, just given what was going down with the economy and financial markets. But ultimately, it was a 2-year program. Given my exposure in DC, decided to get a law degree.
Mm-hmm.
Ultimately, graduating with a degree from Harvard, but knew pretty early on I didn't want to practice law. So after I graduated, came back to New York, started a career as a government bond trader, trading U.S. government bonds, both on the sell side and on the buy side. And then a few years ago, decided to kind of take a step back, start a small family office, just investing, some small money for friends and family. And then that process got into DeFi. So, crypto story, I think this is back in 2013, law school classmate of mine, shows up at my birthday party and he's popping magnums of champagne. I'm like, yo, dude, it's cool. You don't need to do this. He's like, oh, it's all good. It's Bitcoin money. I'm like, what's Bitcoin? This is the first time it hit 1,000. So, he's like, oh, I'm rich. So he convinced me to just like DCA into Bitcoin, drop back down to like 200-300 after that rally. And for the longest time, I was like a Bitcoin maxi, wouldn't touch anything else besides Bitcoin. Think about a little bit of ETH, and I was like, no, I'd rather go back to my Bitcoin. But it was like a few years ago, a friend came. He actually lives out in Thailand as well. But he's telling me about like all these different coins, farming. So I started playing around Ethereum, and it's just super fascinating. The ability to swap tokens on chain, borrow and lend, just all these different things you couldn't do with just like straight, Bitcoin ledger that tracks only one number. So as part of that process, I started to advise various crypto projects. And one of those projects, I served as a DAO treasury manager. And it's kind of in that role, managing short-term liquidity for a DAO, where I started to see kind of, Aave and Compound are awesome, floating rate product, but it's really hard to forecast and budget when, have floating interest rates. And on the flip side, if you want to borrow, there's no way to lock in a cost of funding. So it can be pretty uncomfortable. So that's sort of like the genesis of Term.
So going off of that, before we get to talking about how Term actually works, I wanted to get your take of the current ecosystem that exists right now with the big players in the space, especially with the borrow lending platform. You mentioned Aave and Compound. I think Aave is probably like, but by far the biggest player now. I mean, they're deployed on like 1 million chains. That they have quite a bit of TVL. But you talk about one of the issues being that this floating rate. So for the listeners or watchers who don't know, essentially the way Aave works is you can deposit like a certain number of assets and then borrow other assets. And the interest rates you're paying on the borrow is variable based on like the demand versus supply. So if there are more people borrowing the same asset that you're borrowing, the interest rates will fluctuate upwards. If there's less demand for the assets that you're borrowing, the interest rates will fluctuate downwards. The inherent issue in this is that, especially for like the bigger positions or say the institutions that want to borrow assets on chain, even if the interest rates are lower or higher, like the issue is that they're a bit unpredictable, right? Like you can't anticipate having like a long-term loan on any of these platforms and like sort of figure out like how much interest you're paying over a year, because like the the rate fluctuates daily. So yeah, talk a little bit about like the current ecosystem and like what problems do you see with the traditional borrow lend platforms?
Yeah, for sure. So obviously I don't want to knock Aave. Aave is amazing. Honestly, what they've put together. They've put together the gold standard for, floating rate borrow lend on chain. And they have the most liquidity by far. I think last I checked, it's like 3 to 5 billion. And the peak of the last bull market, got to like over 20, 30 billion, which is nuts. But yeah, there are, some drawbacks to the existing model, as you kind of alluded to. It is a floating rate because the terms are open-ended. You can borrow for as little or as long as you like, and you can lend for as little or as long as you like. And because of that, the interest rate is necessarily a floating rate based on supply and demand at any point in time. And the way that they implement this, I think a lot of people don't realize part of it is algorithmic and part of it is centralized or decided by the DAO. So the way that these protocols like Aave work is any token that's deposited, supplied, can be borrowed. And to ensure that there's liquidity for people who want to exit, while there might be outstanding loans, they have to reserve a certain buffer that allows them to have some liquidity for withdrawals. So typically they have a flat interest rate curve where it goes from 0 to some base rate up to some optimal reserve amount, say 90% for stablecoins. And once the borrow demand goes beyond 90% utilization, the interest rate starts to spike up rather rapidly. So they call it the Aave kink. And where that kind of rate tops out before the kink kicks in, that's determined by the DAO. What you see is that when borrow demand starts to increase rapidly, where that base rate at the kink is too low based on market demand, then you enter that kink where interest rates start jumping up and down quite wildly. And we've seen this now for about the past 2-3 months, where within a single day, depending on what time you log on to Aave, the borrow rate might display 5% or it might display over 20%. And all of this within a single day. And we've seen over the past 3 months, this will happen on multiple days a week. And it's been going on for multiple months now. So, for a casual user who just hops on Aave, you have no idea what you're paying. You log on an hour from now, it might say 15%, 2 hours from now, it might say 7%. It's just jumping around.
The number on the UI is pretty irrelevant at this point, right? Like if you log on and like you look at the user interface, it changes. Like even if you have like a bigger position, or like for example, if you just want to be on the supply side, and you see like the certain APY for supply, if you deposit like because of your deposit, it increases the supply without increasing the borrows, and then like the API can fluctuate quite a bit just by like a single deposit or a single transaction. So I feel like it's pretty difficult for people to gauge like how much they're actually getting by supplying, and then also how much they're paying by borrowing, which is kind of an issue, especially if you're using like a protocol like Aave with size, where like there's a huge difference between paying like 3 to 5% APY borrows on stables and paying like 30 or 40% over the course of like a week or a month.
Yeah, absolutely. Exactly. Just like looking at the historical averages, like the 30-day moving average borrow rate for USDC is about 7.8%. But unless you are, tracking this data, on a daily basis, it's really hard for anybody to know just by looking at the UI what that number is. And it's been coming up pretty rapidly. Just a month ago, this is around 7%. A month before that, 30-day moving average is around 6.5%. And people remember from just, Q2, early Q3 of this year, rates were below 4%. Yeah. So it has gone up rather rapidly in the past few months.
Yeah. So moving on a bit, I want to talk a little bit about how term works because I feel like there haven't been that many like very good DeFi primitives. I mean, like a lot of the new DeFi protocols coming out are sort of like we talk about Aave, that there's probably like 100 exact clones or very close to exact clones of Aave that maybe have like a slightly different tokenomics, like a feature or two, but like the core product is maybe like 90 to 95% the same thing. But I feel like term is a bit different. Like, I guess like let's start there. Like talk about exactly how term works and how they offer fixed rate loans.
Yeah. So I usually like to start with what's similar. Aave is collateralized borrow lend with a floating rate and an open-ended term.
Hmm.
Term finance offers, again, collateralized borrow lend, except we have a fixed interest rate and a fixed term of the loan. So there's a specific date where the loan matures and must be repaid.
Hmm.
So that's sort of what term is trying to offer on a base level. I think, the key innovation to, previous iterations of fixed rate lending is that, we believe a much more scalable model, right? The
Hmm.
ability to match volumes, in the millions without any slippage. And the way we
Hmm.
do that is a rather, old mechanism. It's actually been around for a few hundred years, and it's just simple auction model.
Hmm.
Um, my prior life as a government bond trader, I had participated in hundreds of U.S. government bond auctions. It's typically a single price sealed bid auction, and every
Hmm.
G7 country to this day also uses an auction method to issue new bonds. And so what we've done is take this auction model and built it on chain to match borrowers and lenders, where the interest rate that comes out of the auction is the rate that the borrowers and lenders transact.
You want to talk a little bit about the auction process, how exactly it works? So, like for example, I guess on both ends, both the borrow and lend side. So, if I'm interested in borrowing stable coins or I'm interested in lending stable coins, how would the process or what process would I go through on term to provide these loans or to borrow assets?
Yeah, so the process, I guess, first thing to know is that with these auctions, it's sort of a coordination mechanism, and that's why it works well.
Uh-huh.
You kind of announce ahead of time. We have a weekly cadence where these auctions occur, typically on Wednesdays and Thursdays. So by doing this, you batch liquidity. Everybody who wants to trade is just going to wait for a certain day and trade at a single point in
Hmm.
time. These auctions typically happen, as I mentioned, Wednesdays and Thursdays, and the auctions open in the beginning of the week on Monday. So
Hmm.
at any point in time between Monday and Wednesday, a user can log on. You can look at the auction calendar. I have details about when the auction closes, what the supply token is, and what the collateral token is that's backing the loan.
Hmm.
It'll also tell you the term of the loan. So typically we've been holding loans with 4-week duration and 13-week duration, but
Hmm.
really it could be, any term, probably up to like say 1 year.
Hmm.
Once you click into the auction, you'll see some additional information like the collateralization ratio. So this is sort of, how much collateral you need to
Hmm.
back every dollar of loan that you take out as a borrower. To participate, you can participate as a lender or a borrower. So on the lending side, you would just submit an offer. The offer form will ask you to specify how much of the supply token you want to lend, and then also specify a minimum interest rate that you're willing to lend at.
Hmm.
It's important to note that the interest rate that you submit will be hashed on chain. These are sealed bid auctions, so nobody can see the rate that you submitted.
Hmm.
And in doing so, you can feel comfortable knowing that you will never do worse than the interest rate that you submit, but you may potentially do better.
Hmm.
Once you click submit, your supply token will get locked in the smart contract for the remainder of the auction. And that's just to ensure that we can clear it and you won't disappear on us when the
Hmm.
auction comes time to clear.
Hmm.
On the borrow side, It's a very similar process. So you would specify as a borrower the amount that you're looking to borrow. Then you would specify the maximum interest rate that you're willing to pay on the loan. As before, this interest rate will be hashed on chain, so nobody knows what that rate is. It's hidden.
Mm-hmm.
So you can feel comfortable knowing that you won't do worse than that rate, but you, again, may potentially do better.
Mm-hmm.
And then lastly, we'll ask you to specify how much collateral you want to post. There will be a minimum requirement, but you can always post more if you want some extra buffer against liquidations.
Mm-hmm.
And in both cases, you can submit multiple offers or bids within a single transaction. So if you want to spread out these orders, you can do so.
Mm-hmm.
Once the auction closes at the specified time, no further bids or offers will be submitted into the auction. What the smart contract will do is run an algorithm that determines the single price, the single interest rate, that maximizes the volume matched between borrowers and lenders, where any borrower that's willing to pay at or above the clearing rate receives a loan, and any lender that's willing to lend at or below the clearing rate makes a loan, in both cases at that single clearing rate. So really drive
the entire auction, at the end of the process, the entire auction, there's one clearing rate for everyone that's involved in the auction, right? So like it is like it sort of figures out like what is the maximum utility for both the lenders and buyers. Like how can we maximize the expected value, where like the majority of people that are participating in the auction get to participate it within like a certain range or time, or like a certain range of bids, and then like going from there, you settle on a price where like you try to include as many of the participants in the auction as possible.
Exactly. If people who've taken econ, it's kind of like the supply and demand curve where they intersect.
Yeah, that
essentially
makes sense.
what the smart contract does.
Yeah, I want to talk a little bit about the collateral in terms of what types of. So I imagine most the auctions are for borrowing stablecoins. Is that correct?
It could be really any ERC20. Our most popular auctions have been borrowing stablecoins, and the second most popular is borrowing ETH.
Okay, interesting. So, and then the collateral provided, I assume, it's either other stables, Ethereum, or like derivatives of Ethereum, like liquid staking tokens as well.
Yeah, so really it could be any ERC20, but the most popular collateral tokens tend to be yield-bearing tokens. So wrap stake ETH is very popular.
Yeah.
You can earn on your collateral, and that helps to defray the cost of your borrowing.
Yeah. I think that's an interesting point that we can talk about, because I feel like that there's a pretty big push recently for native real-world assets, whatever you want to call them, or yield-bearing assets on chain. So one of the disadvantages I see with this platform compared to something like Aave, well, I wouldn't say a disadvantage, but like in terms of like the overall yield side, is that like, for example, if you deposit collateral on Aave, you're earning yield on that collateral regardless of if it's a real world asset or a yield bearing asset or not, because with that collateral is then relent out on the platform to people that may borrow collateral, which in my eyes, may be a good or maybe a bad thing. Obviously, the good part is you generate more yield. The bad part is you also inherit more protocol risk, because now like the protocol doesn't have like the specific asset that that you're depositing, and if it's lent out and being collateralized by like a shadier asset or like a less liquid asset, it can lead to possible some downside risks, some bad debt on the platform. Yeah, so I'm wondering your takes on that. Do you think there's like risks in the Aave model in terms of like the way they handle their collateral? Basically on Aave, unless like a pool is isolated, you essentially can deposit like whatever asset and borrow whatever asset you want, and then like your collateral is also lent out to anyone else that uses the platform, and they can deposit whatever asset that they choose to deposit as collateral and borrow your asset.
Yeah, no, I think that's Aave's greatest strength and also greatest weakness. I think the reason why Aave has gotten so much adoption is this rehypothecation that you're talking about.
Mm-hmm.
When you supply an asset as collateral, it is simultaneously also then can be relent out.
Mm-hmm.
And so people who are lending, the supply that's being borrowed, in many cases, is just being used as collateral for some other borrow. And that's what makes Aave super capital efficient.
Mm-hmm.
And I think that's why they're able to attract a lot of supply, because the suppliers aren't actually there to supply, they're there to borrow. Mm-hmm. And it's just kind of a byproduct of their collateralization that it creates further supply for other people to borrow. Mm-hmm. So that's what makes Aave super capital efficient. And I think that's why they've grown so much, to the point where they actually outpaced Compound. Mm-hmm. But this does come with some risks. When you rehypothecate, that means that the collateral that you have deposited into Aave isn't actually there. In most cases, if withdrawals are, coming in just like kind of like a bank, small amounts each day, then as long as you hold some reserve and that buffer is enough to satisfy any withdrawals, and you have this interest rate kink mechanism that kind of mm-hmm. will disincentivize or bring in more capital, then it works. But lurking underneath this entire system is that, potentially room for a bank run, mm-hmm. where if everybody decides at the same point, oh, there's not enough tokens there, mm-hmm. I better get it before somebody else does, then the whole system can collapse. So it's very much like a traditional bank run with mm-hmm. fractional reserves. The other, I guess, same thing, the strength and weakness is that Aave has these collateral pools, and you can, mix and match, borrow against, mm-hmm. and lend against, anything, any collateral token within that pool. But I think what people have seen recently with Curve is that creates some contagion risk, mm-hmm. where if any one collateral within that basket, becomes questionable, then that threatens, everybody who's borrowing or lending in that entire basket. So I wouldn't say it's necessarily a bad thing. It is just a risk, and it does have benefits that offset that risk, which is the capital efficiency. With Term, we opted for a different model where we uh-huh. isolate all the collateral. So that's kind of...
Yeah, I think that makes sense. Obviously, there's advantages and disadvantages to both. I think we've seen a lot of the instances of... I mean, Aave and similar haven't really gone down, but I feel like there have been a decent amount of risky positions. Like the biggest one that came to recent memory was Michael Ergov's Curve position. So basically, he had a very large percentage of the on-chain float of Curve, and he was borrowing stable coins against it. And the interesting thing about the way that these platforms work is that essentially you need to maintain certain collateral ratios, and the collateral ratios are determined from asset to asset. So the more stable, I guess you call them, the higher market cap, more fundamentally liquid assets you can borrow more against. The smaller cap, riskier ones, you can borrow less against, which makes sense. But it's interesting because, for example, if I deposit Curve, I'm going to deposit a small amount of Curve and borrow a small amount of dollars. But if you have 30% of the on-chain Curve or whatever it was deposited into one market, the way collateral is calculated is basically you use on-chain oracles or whatever. Basically, an oracle will spit out a price feed that the price will determine the value of the collateral. But things change very quickly when the market price of these assets doesn't necessarily reflect the liquidity of these assets. So if you go down from asset to asset, they have varying on-chain liquidities. Yes. So I want to talk a little bit about liquidations and how exactly you protect from bad debt, because I see one of the biggest problems of these platforms is if someone opens up a very big position with even, I wouldn't say Curve, the token is a even a questionable or shady asset, but we see at some points the on-chain liquidity for even such a larger market cap asset is fairly limited. Where if a liquidation event did occur, it would incur quite a bit of bad debt on the platform, because all the USD is lent out. You have a lot of Curve. If you liquidate a Curve, it would cause cascading liquidations. It would drive the price down even further, where the the Oracle price isn't going to be close to the price you're going to get on your liquidation. So talk a little bit about that and how liquidations on, or I guess Oracle pricing liquidations on term work.
Yeah, so you're absolutely right. Every lending protocol, there's an implicit assumption that you can sell the collateral at the Oracle price or close to it. And the buffer, the over collateralization ratio, that buffer is meant to be address any slippage that might come. So, if you take the Oracle price, even if there's slippage, hopefully, the 25%, 20% extra buffer, after you take out incentives for liquidators, will be sufficient to cover any potential slippage. But yeah, there is this implicit assumption that not a lot of casual users are thinking about. And, personally, when I think about, what is the cap on borrowing, you really want to think about what is the most that you think you can liquidate within a single block before the slippage exceeds that buffer that you've built in to the protocol. For us, we're focusing first on highly liquid blue chip assets, so wrap stake ETH as collateral, SDI as collateral. So with these tokens, you can expect relatively deep markets that can handle potentially millions, tens of millions in liquidations without any significant impact on its underlying price. But yeah, once you talk about tokens like Curve, and given the limited float that's actually in circulation, that's not locked up in VE, on-chain liquidity, it's actually quite limited. I think a good rule of thumb is you never want to be more than 10% of on-chain liquidity, right? Because at a certain point, based on the constant product pricing mechanism, beyond 10%, that price is going way out of your range. So that's just kind of like a back of the mind heuristic that I follow when thinking about these smaller market cap coins. I think the good thing, though, about having isolated pools or isolated pool model is that it really forces the lenders to think about the collateral risk that they're taking, because they're taking collateral risk with respect to only one token. If the lender is willing to take the risk, then it's really up to them. I think part of the problem with Aave was that for a lot of casual users, they didn't even realize that was a risk that they were taking. And when it happens, like, oh shit, I didn't know that's happening. Now I know. I better think about that next time. So part of it is just lack of education. Because maybe it's okay if you're taking that risk, if you're getting paid for it and you're charging for that risk. But I just don't think people were even factoring that in.
And in all fairness, I should clarify that nothing actually happened to these Aave positions, but right now we're basically speaking hypothetically, where if I mean maybe not exactly hypothetically, since at some point they were at risk, but the whole Curve situation sort of played out okay, where the Aave users didn't actually lose any funds. There wasn't bad debt issued on the platform, but it just shows a hypothetical vulnerability of the way Aave and similar products are run, where large market movements within certain coins compounded with lack of on-chain liquidity can cause quite a bit of problems for a lot of these protocols.
Yeah, no, for sure. I think luckily it wasn't a problem, and I was really impressed how Egroff got all these tokens distributed into private placements and got it off Aave, and that's a real. I mean, for him, he could have just said, "Screw it, I'll take the money and leave."
He could have just left his Curve to get liquidated and ruined.
Yeah, just have some cash and you'd be good. But yeah, he saved the ecosystem, so that was good on him. But yeah, it was like a wake up call. Luckily, nobody got hurt. But it was a wake-up call that, hey, you should be thinking about these risks when you go into Aave.
So the forms of collateral I noticed on the site, I think you mentioned as well, but you're using the stake wrapped Ethereum, the Lido stake wrapped Ethereum, which is essentially it's not, I guess people are referring to anything that generates native yield as a real world asset, even though I wouldn't consider stake wrapped Ethereum a real world asset. But and you're also offering SDI, which is the Spark protocol the DAI Spark protocol. Essentially, you deposit DAI into SDAI, and the SDAI generates yield from depositing the underlying assets into real world assets. I feel like there's been quite a bit of push for either like real yield on chain assets or like yield bearing assets. Like we saw something like Mantra and Blast, basically like Ethereum layer twos that have talked about launching, where essentially like every asset on their chain will be like a yield bearing asset. And then there have been quite a few companies that are trying to build protocols or bring real world assets to chain. So I guess talk a little bit about this trend, how you guys are incorporating like this trend into your platform, and if you think it'll continue in terms of like now, I guess it's sort of limited to like stable coins depositing their dollars into say U.S. Treasuries, and the U.S. Treasuries like gain some yield. But you think this trend will expand to other avenues where there will be like a whole suite of real world assets being able to be deposited and traded on chain?
Yeah, for sure. So, kind of connecting back to the previous conversation, we do not rehypothecate or relend collateral assets.
Uh-huh.
And because of that, we prefer onboarding interest-bearing collateral because that allows the borrower to, get maximum capital efficiency out of that collateral. Of the collateral that we've been taking, as you mentioned, wrap stake ETH is common, SDAI is common. And we recently also hosted a pilot auction using Matrix Port's STBT, short-term T-bill token, as collateral. And that was the first sort of permissioned RWA token that was used as collateral in a fixed rate auction. High level, I think anything that generates, I guess, what I call real yield, whether it comes from off-chain world like T-bills or it comes from on-chain, activity, I think that's a net positive for the ecosystem. I think in the previous bull run, it was just crypto people making money from other crypto people. It was kind of a closed loop system.
Yeah.
And the only people were the people coming in generating liquidity. But then when that flows out, it disappears.
Yeah.
So to the extent that we can start bringing, off-chain income on-chain, I think that grows the pie for everybody, which is a good thing for the ecosystem. But yeah, obviously most simple to start with the kind of DeFi native RWAs, I guess you call it, real yield assets, like stake ETH and SDAI. But I think, as more of these permission like RWA tokens come on, I think that will be a major opportunity. I think there's a report from BCG. They were estimating something like this market growing to 10 or 16 trillion, which would be like 16 times total crypto market cap.
Yeah, that's insane.
As people start onboarding, there are a lot of benefits to this RWA because they call it, I think what they're calling it is collateral composability or mobility. When you think about TradFi, you own a house, you can get a mortgage, but it's kind of clunky. You got to call a bank. There's this whole process to that. Or if you own a car, you want to get a loan on that. It's a difficult process. Once you tokenize it, it's really simple to just plug into lending platforms like Term or Aave to get liquidity out of your tokenized assets.
Yeah.
So I think tokenization paired with on-chain lending will really unlock a lot of liquidity for people who hold RWAs, and that'll be a big driver. And so part of what we want to do is kind of be the rails that allows people to kind of lock in fixed rate borrow cost on their RW assets as they start to come into the DeFi ecosystem.
Yeah, that makes sense. One of the biggest issues I had with the previous DeFi cycle, I guess people call it DeFi summer, was you talk about it a little, but it felt like it was very PvP, where like it wasn't exactly clear where the yields were coming from. Like you're making quite a bit of money, but on the other end, there are probably people like losing quite a bit of money by doing stuff that made you profitable. But like there's this old meme that's like, if you don't know where the yield comes from, you're the yield, or something
Yeah,
like that.
exactly.
But yeah, I think this push to generate like actual, real, sustainable yield, whether it's like the real world assets, something as simple as U.S. Treasuries being able to capture that yield on chain, versus like the staked Ethereum. We see the like liquid staking on Solana right now, taking off. Um, I feel like at the point where DeFi can point to like certain aspects of what they're providing to the end user, where like yield is generated here, there, and there. Therefore, you're making money rather than say just like printing governance tokens, like basically trading money printed out of thin air,
Yeah,
which is
exactly.
like the previous cycle. I think that it might be less fun for the end user, but it leads to like a more long-term sustainable like ecosystem where like more people can get in. It's sustainable for them. More institutions or
Absolutely.
more first-time crypto users can get in and like very basically understand the concept that like, yes, I can deposit these assets, but they're generating yield and I can use them as collateral. It's like fairly simple rather than trading around like the 70th Aave fork with like their own governance token, like looping your collateral, or doing whatever that people were doing in previous DeFi summers. So yeah, like overall, I'd say it's like a pretty bullish look on DeFi, that like there's so many companies in there, and there's so many protocols incorporating these assets on chain now.
Yeah, for sure. I think it shows the maturity of the ecosystem. Um, and yeah, there'll always still be, those moonshot plays, that'll
Mm-hmm.
never disappear from crypto.
Mm-hmm.
But it's also good to have some, general income flowing into the ecosystem and kind of staying in here
Mm-hmm.
to grow the pot.
Mm-hmm. So before we let you go today, I want to talk a little bit about like your future plans for term. Is there anything in the works? Some stuff I'm thinking about is like new assets you would like to offer in terms of either collateral or assets being able to borrow, new features, possibly moving cross chain, like, or at least using different chains. Is there going to be a token? Is there going to be an airdrop? I feel like there's always demand. Like it's like airdrop token season. So
Yeah,
I felt like I had to ask.
yeah, for sure. So in terms of multi-chain, we are currently getting that wrapped up, and we'll be deploying on L2s, relatively early in the new year.
Hmm.
We're thinking potentially base as that first chain,
Hmm.
but there's this Blast L2 coming out. Maybe that'll be an interesting opportunity.
Yeah.
So we'll see where we deploy, but that should be coming pretty shortly.
Hmm.
In terms of features, I think another feature that we'll be coming out with is making it easy for passive lenders to get involved with term.
Hmm.
Right now it takes a relatively sophisticated user to come every week and participate in the auctions.
Hmm.
So, create some sort of a listing contract where lenders who obtain lending tokens through an auction can then resell it,
Hmm.
and then allowing passive users to just come, whenever they want to come buy those tokens
Okay.
and earn the
Are
yield.
you saying like, so for example, the lender can sell their position like midway through the term of a loan?
Exactly. And
Okay.
then some of them might even do this as part of just like a distribution process
Yeah, I
to
see. I see. Okay.
distribute to more passive users.
Uh-huh.
Um,
So
but yeah, I think a
it'll be
big
set up as like a secondary marketplace for like loans. Essentially, you'll be able to trade debt back and forth between users.
yeah. I don't like to use the word secondary market, but yes,
Yeah, okay. Fair,
exactly,
fair. Yeah.
exactly, yeah. And I think that'll make a better user experience for more passive lenders,
Hmm.
to help kind of increase liquidity.
Hmm.
I think there'll always be a group of people who like to play in the auctions and be
Hmm.
active, and there'll be a group of people who just want to buy the yield and just sit on it.
Hmm.
So that's what we're gonna be coming out, and then yeah, I think in the new year, I think a big push will be a points program. Can't really say where that leads, but I think a points program will be a key component of our go-to-market strategy.
Uh-huh.
Um, the first few months since we launched in Q4 has been really proving out product market fit. We've got, quite a bit of user demand, large institutional borrowers. We've proven out the model, been able to clear very large loans in these auctions, fixed rate loans at scale, which hasn't been done on chain before. So I think the next move will be, all right, now let's get out there into the market, spread the word, and get people to try out the product.
For the listeners or watchers who don't know what a points program is, I feel like it's a recent trend, but essentially points are promised future tokens in case that there's an airdrop for participating in certain ecosystem or protocol related activities, I guess you'd call it. So like if I'm not going to speak on Dion or terms or term here, but like in general, if you were to participate in a few of the auctions, if you were to provide liquidity, if you were to borrow, you could possibly be earning points, which would generate future tokens. Possibly, I'm not exactly sure, but that's essentially the idea of generating points. Would you say that's accurate?
Yeah, I'd say that's pretty accurate.
All right. Before we go today, for the users who don't know you or don't know anything about term finance, could you let them know like where to find updates, how to participate in these auctions? I think you mentioned the auctions are like Wednesday, Thursday.
Yep, Wednesday, Thursday. There's an auction that will be closing tomorrow at noon. That'll be, one of them is USDC against Wrap Stake ETH, and the other, actually it's Thursday. It's already over. Shoot, next week.
Yeah,
come back next week. But yeah, the website is app.term.finance. You can also follow us on Twitter, term_labs. And we kind of post all of our auction results on a weekly basis. We post announcements for new upcoming auctions. So definitely check us out on Twitter. And yeah, hopefully we see you guys, try out the protocol.
Yeah, it sounds good. So in case you have some like wrapped staked Ethereum, you want to borrow some assets on, you don't want to deal with the variable cost of Aave. Like every Wednesday or Thursday, you can look on a term finance to see if you can get those loans at decent prices and go from there. I appreciate your time today on coming on the podcast. Yeah, it was a great talk, and I really like DeFi protocols that are doing something unique. And I feel like Term really falls under that category. One of the issues I have with DeFi is it's very repetitive. There isn't much innovation. So it's always nice and refreshing to talk with founders of protocols that are doing something new for the space.
Thank you. I really appreciate that. And thank you so much for having me. I really enjoyed being on this podcast and being able to chat with you.